Hello everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmgren, and with me here in the studio is my friend and colleague Niklas. How are you?
I'm happy as we today are going to speak to Carter Johnson, the founder and manager of MCJ Capital Partners. We met Carter in Omaha actually over dinner earlier this year and realized we have a common interest in serial acquirer companies.
We definitely have, and for today's episode, our guest has selected the book Distant Force, a memoir of the Teledyne Corporation and the man who created it, written by Dr. George A. Roberts and published in 2007. Here comes our conversation with Carter Johnson. Welcome to the podcast, Carter, and thank you for taking the time.
Hey, thanks for having me. Glad to be here.
And where are you today?
I'm in Denver, Colorado. So, it's November when we're recording this. We're getting to those points where we're starting to get a few snow flurries out here.
Nice. And let's start with your passion for investing. How did it begin?
Yeah. So, I caught the bug early on. I was always, starting these little businesses and side hustles. And, when I was 12, I took some money I made from a little lawn company I had, and I opened up a brokerage account in my stepdad's name, and I was kind of off and running and just, learning on my own and having fun in the process.
And today I have chosen the book Distant Force. Why is that?
Yeah, so for me, when I analyze companies, I spend a lot of time on the qualitative analysis components of it. I really love serial acquirers. So diving into Distant Force and studying the internal workings of one of the best serial acquirers out there, for me, that was really time well spent, especially just helping with overall pattern recognition of companies.
And some of our listeners are, of course, familiar with Teledyne, but some are not. And in the book, the company is described as one of the most outstanding corporate success stories in the history of American business. So how much value did shareholders in Teledyne gain during Henry Singleton's time at the helm?
Yeah, so Singleton started the company in 1960, went public in 1961, and you can certainly cherry pick a few different decades where returns were better than others, but throughout his reign, he generated a 20.4 CAGR for shareholders, so quite impressive for sure.
Yeah, pretty amazing. And his right-hand man for a lot of that time was Dr. George A. Roberts, the author of this book that we're speaking about today. Can you briefly tell us about his role and about him?
Yeah, so Dr. George Roberts, he's another fascinating guy. Him and Henry Singleton, they were actually roommates at the U.S. Naval Academy, so they knew each other from their time in college. Roberts started his career at a company called Vasco, did really well there, rose to the ranks of president. And then in mid-60s, about 6 years after Teledyne was founded, him and Henry Singleton negotiated a merger between the two companies. And that brought Dr. George Roberts on board. What I love about Roberts actually writing this book, we can get into some critiques and everything, but what I really love is he was very much a boots on the ground guy within the Teledyne operation. So when they were looking at acquisitions, a lot of times he was going out to these facilities, meeting with management, technical staff, really learning about the business, what it needed, how it worked. So he had a really, intuitive feel for the internal operations. And that was my goal when reading this book, was really to understand those internal workings. Eventually, after Henry Singleton retired, Dr. George Roberts took over as the president, and eventually he retained the position of chairman of the board until he retired. So super knowledgeable regarding the entire company, and he gives a great firsthand account of how a lot of things worked.
And a few words maybe about the businesses that Teledyne had. What kind of industries were they in and so on?
Yeah, so regarding industries, they were very technically heavy, and we can get into that a little bit with regards to the type of businesses. But they, especially in those years in the 60s, they were heavily focused on acquisitions of technical companies that would create strategic advantages going after government and military contracts. And we can talk a little bit more about Henry Singleton's strategy with acquisitions. But that's, if you're looking at a broad stroke of the companies that Teledyne largely acquired, it was these niche technical expertise. And then the genius of Henry Singleton was he knew how to stitch these things together to create those 1 + 1 = 3 type of situations.
And some of you listeners might remember the name Singleton from Will Thorndike's great book, The Outsiders, which we discussed with him in episode 30. But Distant Fourths, it goes even deeper and tells more about Henry Singleton as a person. So who was he?
Yeah, well, I think a lot of people know him as a great capital allocator. A lot of people know that he was, a chess master. I love to study kind of just the habits of high performers in general and really peel back the layers and kind of learn more about him. A few observations regarding Henry Singleton. One, the guy was actually a health nut, and he was ahead of his time. He operated it during a period where everybody was just like smoking cigarettes nonstop in the U.S. And he was really he was health conscious to the point where he installed a corporate gym before that was a thing, right? Like nobody was doing that. He would work at a drafting table, so he would be able to stand up and just get more movement during the day. So I thought that was pretty cool, his devotion to health. The other thing, he was also a huge computer guy, and this was before computers were a main component in the workday. And he was always tinkering on a computer, always trying to figure the newest thing regarding computers out, and he used that a lot within his own day-to-day operations, which was pretty interesting. I think my favorite component, though, about Henry Singleton, so most people know him, for Teledyne and as a serial acquirer. Fewer people know that he was he was a huge acquirer of land in the United States, especially in the latter part of his life. He went on a spree where he was just acquiring all these ranches across the western part of the United States. And at the time of his death, he was actually the third largest U.S. landowner, which is pretty amazing to think. But what I find really fascinating is one of the things that Henry Singleton would do. He would acquire these ranches, and then he would essentially take over the function of being the bookkeeper. So he oversaw all the expenses, he signed all the checks, and he saw this as a form of discipline, but he also saw it as a way to intuitively understand the operations of the actual business of the ranch. And I just think that's such a powerful lesson and something that we can replicate as investors. I find it really beneficial a lot of times to recreate the financials of a company by hand versus just dumping it into an Excel sheet. You pick up on those components that, doing it the hard, laborious way, you pick up on a little bit more than if you just spit out a model. So I don't know. I've always thought that was really interesting when I learned that about Singleton.
And when Henry Singleton died in 1999, George Roberts, the author, he said at the funeral that Henry was much more than a salesman, mathematician, engineer, inventor, and chess champion. He was a student. And is that something that you feel like many of these great leaders have been during their time? They have been a student and always wanted to learn. Oh,
that's absolutely. I think that's a constant, and it's not just with the great investors, it's also the great operators. Sam Walton comes to mind immediately. He was the same way. He was always learning, and he would go out into the field and look at competitors and understand what it was that they were doing. Obviously, Buffett and Munger talk about the values of being a lifelong learner, and that's such a constant in terms of these high performers. They enjoy that process of learning.
So if we dig a bit deeper into Teledyne, as you said, it was a serial acquirer who bought actually 130 companies in 8 years between 1961 and 1969. But then actually stopped since prices had run up and also that the best companies had been bought. Can you describe how Teledyne thought about acquisitions and what hurdle rate they used and so on?
Yeah, so I mean, if you look at the early days, we'll start at the very beginning. Most of the first moves that Singleton made, they were geared towards more asset-based acquisitions, and in particular, Henry Singleton focused on acquisitions that had excess capacity. So he went out and he would buy a company that had a manufacturing plant, that had a warehouse, that had labor, and once he had that in place, he had everything he needed to then go and bid on these government contracts. And that was a huge, almost like arbitrage of resources, if you will. He knew how to do that. Once he had that in place, again, Singleton, he's a chess master, so he understood how to move the pieces, and you really see that unfold with kind of his next wave of acquisitions, because this is where he would focus on that 1 + 1 = 3, in the sense that he would go out and he would look at companies, figure out what technology his current holdings had, and then what technology and components he could go out and acquire and make his position that much more competitive in going after these government contracts. So it was really, he had that foresight to actually understand the process of bidding on these government and military contracts, but then also how to make them that much more competitive in that bid process. Once he kind of had that stabilized, he then started moving both upstream and downstream, acquiring manufacturers of these internal components that would go into the end products of Teledyne. So he really had, vision just across the field, understanding where to capture value in that value chain. As the entity swelled larger and larger, you really notice that Singleton focused more on the profitability side of acquisitions and the diversification. He saw diversification as a way to minimize overall risk. So you really start seeing the acquisitions kind of balloon out, expand out into other areas. Regarding hurdle rates, one of the things I found interesting is studying Teledyne. Internally, one of the things they would mandate is a 20% hurdle rate return on assets for their profit centers, and any cash that profit centers retained, as opposed to returning to headquarters, they were required to produce that 20% hurdle rate. So I think headquarters hurdle rate was a little bit different, but that kind of gives you a good sense of what Singleton was thinking internally in terms of returns that he was trying to generate on capital.
And at Redeye, we have this Redeye rating where we have 3 different categories that our analysts use when they analyze companies. And one is financials and one is business. And we talk a lot about this here. But the first one that we have is people. And Henry Singleton actually said that people were the most important factor in a business. So can you talk a bit about how he managed the culture while growing so quickly with M&A?
Yeah. Well, I think one of the advantages he has was so much of it was decentralized, right? So Singleton was a huge believer of, if your people are hitting their marks, let them run their own show, let them do their own thing. And that type of autonomy, I think, was really valued, as it is today, but really valued during that time period. The other thing that I think Henry Singleton did a phenomenal job of is he knew how to make people feel important. And if you look at the organization structure, and if you look at these profit centers, the manager of those profit centers, they would actually retain the title of president. And Singleton did this intentionally so that there was this level of credibility and respect that those individuals would garnish in their community. And he encouraged them to maintain those local relationships, so maintain a local bank account versus going to some national regional type bank. And then the other thing regarding just making people feel special, he was very much adamant about having up-and-comers and different individuals accompany these profit center presidents to the 3 meetings that Teledyne would have with their profit centers every year. So again, he was just, bringing these other individuals so they could see more of how Teledyne worked collectively and get to know them, and then also understand, if they would be a potential candidate to replace their successor, so to speak.
I think it's interesting, having followed the serial acquirers for quite a long time and going deep into many of the Nordic ones. You look at, for example, the differences between some acquirers who do more of the Buffett approach, I would say, just buy good companies and leave them. Others have a more like industrial logic behind buying companies, and it's clear that Singleton is in that bucket, I think. And I mean, my impression is that they actually bought good companies that were not really connected to that if they found them, but that was not the key business. And I mean, it seems like he early saw certain trends in the market in terms of semiconductors and so on, and he wanted to capitalize on that. Can you maybe go a bit deeper into that, and when you look at serial acquirers, how you feel that they differ and why and so on, and when maybe one way is better than the other, so to speak?
Yeah. So, well, I think one of the advantages Singleton had was he understood the backdrop going into the 60s. He understood that World War II had created this catalyst for all these new technologies across American manufacturers. And a lot of these owners were looking to either retire or take on capital to grow. And Singleton knew he had that environment, and eventually that became so saturated that opportunity set disappeared. And we can talk a little bit about that and how the 70s unfolded. But again, he had this backdrop. He understood the surplus of these businesses at reasonable valuations that existed, but he also understood how, and I keep saying it, that 1 + 1 = 3. He understood how to stitch these industrial manufacturers of these technology components together to create this added gain. And I think that was, really, really advantageous, especially in the early years when they were securing these government and military contracts. I think nowadays, if you look at some of the best serial acquirers, I love following serial acquirers that really focus on acquiring these monopolistic players in these super niche markets. And a lot of times those have less expectations of integration and creating those 1 + 1 = 3 situations, but they'll maintain that market share. There's a lot more durability there. And I would almost argue under that model, there's a little bit longer of a runway because you can keep finding these niches as opposed to being dependent on creating those value adds with synergies of stitching multiple companies together. So those would be my thoughts, at least on that.
I mean, just thinking about it as an investor, I can just imagine how difficult it must have been to as an investor to hold on to this stock when, I mean, first they bought all these companies and the whole playbook was around growing through acquisitions, and then it just flipped. And I mean, yeah, it definitely worked, as we will hear more about. But yeah, it's
well. And to your point, you think about it. It's the 60s. That was the go-go era. Conglomerates were they were the technology companies of this most recent bull market. So to differentiate between Teledyne and these other conglomerates, I mean, you really had to think that you had something special with Henry Singleton. And to your point, it would have been pretty difficult, I think, to hold on, especially once you hear that Singleton and Roberts are shutting down this acquisition machine that over the decade has produced these tremendous returns.
And at that moment, they also did something else inspired by General Motors, a book that he has read, Singleton. Then he diversified into insurance and financial operations because he wanted to ensure financing in these tough times that he was thinking coming. But who would have guessed that would turn out so well?
Right. And it wasn't the easiest transition either. There were some mishaps there. They took on some insurance that had a lot more long tail risk than what they realized, and ended up having to take a hit there. But yeah, I think again that's one of the things, and I think what makes Henry Singleton so impressive in terms of a capital allocator, he knew how to work both sides of the balance sheet. He knew how to find value in whatever it was he was doing, and he was adaptable. So he didn't, he just didn't have one lever in terms of, hey, we're just going to do acquisitions. We can talk about it, how he bought back stocks, he issued dividends, he, did some creative things with bonds. So he had a lot of tools in his tool belt, and the 60s gave us a glimpse of that acquisition side.
And if we go deeper into the fact that, as you stated, that 1 + 1 = 3, a lot about this is about how to add value as an owner, and the author describes a lot about the method the company used to manage the different business units and to track the progress and branding of the business units and so on. So if we start with managing the business units, can you tell us a bit about the methods Teledyne used?
Yeah, that to me was the most impressive, and that's really what I enjoyed digging into. So first off, when Teledyne was acquiring companies, a lot of times they would pursue acquisitions where the owner was looking for retirement, so they're going to leave the business, and this fit well for Teledyne. They would actually go in, they would do an acquisition, and then they would place a corporate accountant to initially take over management. And what this would do is this would create and allow a time period where they could create this uniform financial and reporting standard. And a guy by the name, actually George Ferensky, I believe, he was the one who designed the financial and operating reporting system. And keep in mind, when I go through this is a time period when people weren't firing off emails and having cloud-based spreadsheets operate or update in real time. So it just makes all this that much more impressive. But if you look at the system they had for managing these entities, all of the profit centers, they had a comptroller that reported directly to both the profit center president as well as the corporate comptroller. And all of the banking was local. Again, Singleton was big on maintaining those local relationships. But on Fridays, these comptrollers would actually figure out what it was they needed in terms of cash for the next week. And headquarters, corporate, would either deposit that, or if there was excess, that would be returned to corporate. And so they really created this nice, tight feedback loop of essentially 1 week going forward. In addition, all of the fiscal months for Teledyne's profit centers, they would end on a Friday. And what's really, really impressive is the fiscal months would end on a Friday, and then reports on those profit centers would be generated and available on Tuesday the next week. So quite the turnaround for an entity that size with that many different moving parts, and in a time period again where it's not like you were just firing off emails left and right to get stuff done. So that was pretty. I found that system pretty fascinating. The other component that was really dialed in was that again, Singleton believed like, hey, let people do their job. You don't need to interfere on the day to day. But they would have 3 meetings per year with their profit centers. And these meetings were broken into a capital asset plan where the company would go over what they needed in terms of CapEx, what they were thinking in terms of any acquisitions that they were looking at, and then also their research budget. So they would have this capital asset plan meeting, and then they would also have a profit plan meeting, which typically occurred about 2 months prior to their fiscal year starting. And then they would have a profit plan 2 meeting just to basically reflect on that current profit plan, how it was going, and then make adaptations for the remainder of the year. So for the most part, they left these business units, left them to take care of the day-to-day and didn't interfere there. From a structural component, the design of Teledyne was also pretty interesting. They would move all of patent and legal to headquarters. And then eventually down the road in the 70s, they created an in-house advertising division that really just serviced all the profit centers and saved some money on synergies and whatnot there. And then another thing they did in the 70s was they created these actual international marketing offices. And this was specifically for these profit centers that were looking to expand internationally. And these entities were created and set up like traditional trading companies where they would buy and sell Teledyne products for their own account. But it would also allow them to have a base that understood the international logistics and accommodations and all the rules and kind of the lay of the land for that territory. So that was just, I thought, pretty interesting in terms of kind of the management and hierarchy of how everything kind of flowed through Teledyne.
And just a short follow up on in most of the serial acquirers we look at now, decentralization is really key of what they do. And in my impression is that Teledyne was really decentralized, but also, I mean, had a clear structure as you described. How different was that compared to the regular U.S. company at the time? And how is it today? Maybe if you can describe how the environment in the U.S. is today in terms of centralization.
Yeah, I think it was really different then. I mean, that was an era where conglomerates were all the rage, but there was a lot of bloating internally and layers upon layers of management. So that part, I think was unique in that Teledyne really tried to minimize those layers. That was really interesting. I think there is an element today that allows for decentralization in American businesses and autonomy, but with an adequate amount of oversight, right? Like there's KPIs and things like that you can force down to that level. But then there's still an eye at the central component that's keeping an eye on it. I don't know. That'd be interesting to kind of think through more in terms of how those compare in today's environment versus historically.
Yeah, why I asked the question is that typically in Sweden, many companies are highly decentralized, and what we often hear is that, like in the US, it's much more centralized, and especially in maybe the rest of Europe, it's more centralized as well. But I mean, it's different in different businesses, and it's just interesting to hear from your perspective in the US how you feel about it.
There's also a fascinating, I don't know if I want to go as far as call it a sigma, but there's a component in the US where people are very cautious regarding serial acquirers. It's not this model that a lot of equity analysts, I guess, really get or embrace. And I think a lot of that is just because so many acquisitions in the US are these make or break, huge acquisitions. And when you have executives who aren't really in their circle of competence when it comes to allocating capital, a lot of times that's a mishap, and it burns the organization. So I think there's this cautious outlook when it comes to entities that do acquisitions, and then naturally, if you're not doing acquisitions on a regular rate, you're probably going to be more centralized, and just to have your thumb over divisions and whatnot a little bit tighter than a decentralized serial acquirer would.
And one important aspect of decentralized business is that you need to have some incentives in place for the people working there. So how did Teledyne work with incentives?
Yeah, absolutely. So one of the things that was really cool about how Teledyne set up their operations, they would have, again, you have this decentralized organization, but they would have these company newsletters that would talk about different initiatives that different profit centers were doing, different knowledge component feedbacks, things of that nature. And that was really kind of a hive mindset of how to share best practices. But within that, they would also broadcast out the results of, they called it the Triple Crown Award. And it was for companies that would set records on sales, net income, and net cash flow. So that was pretty cool to see that, they were prioritizing this, and then that recognition that would go along with it. And then Henry Singleton, he certainly used stock options to attract and retain high caliber management. So I think that might be an area where I wish George Roberts had dived in more, how they structured those incentive systems. But I can tell you, a big part of that was following the progress of those entities and utilizing the Teledyne return, which was that average of your cash return and your profit. So there were incentive systems in place. There were some clear benchmarks and cultural Teledyne type lingo to help drive those marks for their internal employees.
And something else that we have seen when we have looked at serial acquirers for some time is that some companies choose to rebrand the business units, while others, they do nothing and just leave them. So what are the pros and cons as you see it, and what can we learn from Teledyne in this aspect?
Yeah, I think with Teledyne, it's very good case study of both pros and cons. Again, Teledyne would utilize these new technologies to make their bid for government contracts that much more competitive, right? And then anytime you're dealing with contracts of those size, there's a component of reputation that's needed. And the fact that Teledyne was this large company that was publicly traded that had, this balance sheet that looks like X, it would allow them to be that much more competitive in those government contract bids. I think the con of this and something that unfolded at Teledyne, eventually they ran into a lawsuit from the government because there's this discrepancy in the bids on these military contracts versus their commercial clients. And so going back to branding, on one hand, you saw the benefits of having, a united brand. But the con was that when Teledyne got tangled up in this lawsuit, that can potentially jeopardize the entire brand of entities that aren't even related, right? And I think that just magnifies in today's environment where anyone can run a quick Google search and you're going to have news articles populate that talk about a situation. So yeah, those I think are more the pros and cons. I was impressed studying Teledyne. Again, their systems were so dialed in when they would acquire a business, everything from the typeface to be used in press releases to the logos that the business and where it was positioned. All of that was templated to really give a uniform look so that the businesses could operate individually. But if you looked at all of the Teledyne businesses together, you would see this uniform look between the different profit centers.
And going back a bit to Henry Singleton and his capital allocation skills, he definitely was a thoughtful capital allocator. And the most managers use maybe one or two tools, but Singleton had it all, more or less. He issued equity at high valuations to acquire companies. He bought back stock in Teledyne at low valuations. He paid stock dividends and also did numerous spin-offs. Can you try and untangle this a bit for us?
Yeah, I can do my best. We talked a little bit about the 60s, right? That was the period where acquisitions were the bread and butter of Teledyne. They were building the base of the company. As the business evolves to the late 60s, it's clear that the value has ran up in these smaller private businesses, and it's just not there. The price you have to pay to acquire them. So that's when Singleton and George Roberts decide, hey, it's time to shut down the acquisition machine. The problem with that is that all of a sudden cash starts building up on the balance sheet, right? And one observation about Henry Singleton, and I think I've already said it, but he really understood how to invest on both sides of the balance sheet. He knew how to allocate capital. So as you transition out of the 60s, cash is building. And then I believe it was 1972 where Singleton had this realization: the best move to allocate capital was to actually buy back shares of Teledyne, and it was kind of unorthodox at the time because Wall Street viewed any sort of buyback as there's something wrong with the company. So Singleton goes out and he originally, I think he offers a tender of 1 million shares at $20. And instead, he gets 8.9 million shares. And he's like, oh, it's a total fluke, right? And then to his surprise, instead of the stock price increasing, it actually declines, right? So he goes out and he does another tender. And I think this time he gets like 0.8 million shares, but he gets there at like 14. But this is, so those were the first two buybacks. But then you see again the ingenuity of Singleton. He realizes that more than cash, what people want are these fixed income. They have this appetite for fixed income. So he starts actually swapping bonds for stocks. And I believe over the course, he buys back shares for 12 years, starting 1972. And he does something like 4 times in cash, 4 times in bonds. But he ends up retiring something like 90% of total shares out there. And I think there's some quote about that Charlie Munger had on Teledyne and Singleton. He was like, nobody has ever bought back shares as aggressively as Henry Singleton. So, truly fascinating in that component. The other thing that you start to see is in the late 70s, he was issuing these dividends starting in the mid 60s. He was issuing these dividends. But the late 70s, the yield on those started climbing to 8.5%, 10%, which, again, late 70s, he's people know he's doing buybacks. So there's probably less and less value there. And I think that just gives you more inclination to what his thinkings were regarding where value was and using dividend as a tool when he didn't really see a ton of value out there. Just kind of untangling it a little further. In the 80s, he was more into actual like investing in public companies and really found value in buying pieces of public companies versus doing entire acquisitions. Again, I think this was just a little less understood at the time that, hey, you could run a company and have all these operating businesses, and as opposed to allocating capital internally into those operations, sometimes it was better to go out and buy up, shares of other companies and do it at a more minority position, which was interesting. So, yeah, to your point, he had a ton of tools, a ton of levers. Really, just a textbook case of capital allocation viewed through different periods of the economy.
And I mean, he really took advantage of the temperature of the market, so to speak. I mean, when he issued these. When he issued stocks to buy companies, I mean, the valuation of Teledyne was somewhere around 50p or 50, right?
Yeah.
And then in the 70s, it was single digits. So, yeah. I mean, was that due to the conglomerate era? I mean, having an end, and as you said, I mean, investors really disliked conglomerates at that stage, or?
Absolutely, yeah. The conglomerates, heydays in the 60s, and then it was just they totally deflated after that. And I think Henry Singleton, he also understood. He was so familiar with a lot of these conglomerates because he studied them and took the best components to kind of build his blueprint for Teledyne. So at one point, I think it was his old employer, Little, maybe, they had some issue that occurred, and Singleton took half of his equity. It wasn't half, it was a quarter of his equity portfolio. So 25% of it, put it all in that single company. I mean, he had confidence from understanding these other businesses. And again, when you're doing that in an environment where conglomerates weren't popular, you're going to get some good returns on those investments as well. And that's why he did it, as opposed to reinvesting in those operating profit centers that Teledyne had.
Because in the 1970s, I mean, the economic environment was really tough for many businesses. And even if you know how to use all the tools in the toolbox, if you don't have any cash at hand, you can't do that much. So it was quite impressive how much they were able to grow organically.
Yeah, absolutely. Absolutely.
And that was mostly just because they had really good businesses, or what are your thoughts on that?
Oh, on the organic growth? Yeah, I think they had really good businesses. I also think they had that infrastructure that Teledyne had stitched together in the early 60s. Another thing that they focused on Singleton was very adamant about profit centers closing down low margin businesses. So, that was something they were always like encouraging and preaching and everything else. And that kind of weaves through the Teledyne return and that hurdle rate of 20% return on assets. So I think they had those components that helped them on top of this infrastructure that Henry Singleton weaved together in the 60s. And then, the other thing that Singleton was really adamant about doing was during economic downturns, they kind of had a checklist of things that they would go through to shore up the books. They would start shipping products a lot slower to customers who were behind on their bills, and they would get really aggressive on collections. And Henry Singleton just knew this is kind of the genius of him. He understood really how to maximize that cash conversion cycle and when to let it extend and what point of the economic cycle, and when to really like tighten it up. And obviously that feeds through to a lot of the returns and more on the organic side during those 70s.
So I'd like to dig a little bit deeper into the topic of dividends, and that's something we discuss often with investors and serial acquirer companies here in Sweden. And we all know that Buffett, he doesn't pay any dividends and has never done. But in Sweden, it's considered a quality mark. Many institutional investors for pension funds, they demand it. And it is, of course, also viewed as this yield for the owners. But on the other hand, one of the great benefits of serial acquirers is their ability to reinvest profits at high returns consistently over long times. And that makes it quite inefficient to pay out dividends. So what are your thoughts on this?
Yeah, I think you're exactly correct. What makes a good serial acquirer attractive is the opportunity sets they have to redeploy capital. So unless it's this unusual circumstance or there just really aren't any levers for management to pull, I don't want the dividend. A lot of times their opportunity sets are even better than what I can find. Especially when you are looking at these acquirers who focus on these smaller companies that you can scoop up at a lot lower multiples. So, I'd rather have no dividend, but if it's a choice between dividend or poor capital allocation, obviously, I'll take the dividend. I think what makes serial acquirers so unique is that a core competency of executives is allocating capital. And the flip side of that, when you're not really attuned to these acquisitions, you might not be as comfortable with allocating capital. And for some executives, they'll have cash build up on the balance sheet, and they feel like they have to do something, to justify it. And they'll make these poor decisions in terms of taking on projects that really just have overall inadequate returns. And in those situations, I think a dividend is nice because it's almost a sense of focus of, okay, we got to raise the dividend. We've got to keep it at this yield. And it's almost a safety belt for some of these executives who otherwise I think might squander capital in terms of how they're allocating it.
Yeah, but as you said, preferably they are such good capital allocators that you want them to keep the profits. And Singleton's conviction was that the cash definitely was better employed in growing Teledyne's different businesses. But what I think is interesting is, as you mentioned before, in 1970, Teledyne actually introduced these stock dividends where shareholders receive new shares and then they can decide if they want to keep owning them or sell them. So I'm curious, what do you think about this concept? I wasn't familiar of it before.
Yeah, I love the concept. I would love to find a company that does something similar. I'm not too aware of anyone today, but what I love about that, it's nice if you're actually in the business of valuing businesses and you want to control your tax liability, right? And I can talk a little bit about that. Just it's based off the sheer fact that you can choose when you actually sell that piece and incur that tax liability. So that portion is nice. if it's done a certain way. What makes, I think, it difficult is a lot of people aren't following the business on a day-to-day basis, and so they're not going to want to do some sort of computation to see if, when they are selling those shares, if the company's undervalued, overvalued, whatever. So a cash dividend is a lot easier for them in those circumstances. So I can see pros and cons to both. But in general, that's one of the things I think I love to see, and I like it when companies. I actually like when companies do split their stocks, because then you can kind of just peel off pieces as you need it and incur those tax liabilities along the way, versus taking that dividend right there or having to sell off a larger amount than you need. So personally, I like it, but I don't know if it'll become too popular anytime soon.
We will see. The other option is to split into a B share.
Yeah.
We've seen one example of that.
Yeah.
But for Teledyne, I mean, they actually chose to split up the business.
Mm-hmm.
And that sounds a bit unfamiliar. I mean, many of the serial acquirers here in the Nordics, they say that they are forever owners of the businesses that they acquire. Why did Teledyne split up?
Yeah, so I think at a certain point, and conglomerates have always struggled with this, you get to a point where the value placed on the business, it differs from what is actually the intrinsic value. So what the business is being priced at is different from that intrinsic value, and that theory exists. If you split up, you can provide more transparency, and the market realizes that, and then that feeds all into your cost of capital, cost of equity. I think another, really one of the better arguments regarding spinning off businesses is when you have talented management at the head of that business unit, and that to keep them motivated, they want to run their own show, and I think in those senses it makes a lot more sense, because you can get a lot of employees rowing in the same direction with a more clear goal of, hey, this is the value we're driving for the business, as opposed to if they are under just a giant conglomerate or holding company where there's less feedback regarding the value that they're creating for the entity.
Yeah, and there's also the challenge of succession, and that was something that Teledyne faced, and was one reason why they broke up the businesses, as I understood it from the book, right?
Yeah, I believe so. I'd have to go back and check on that, but I believe so.
Because we spoke to our common friend, Adam Mead, quite recently about his masterpiece on Berkshire, and there I asked a bit about why he thinks that Berkshire should not be broken up into pieces, and he says that there are so many synergies within the Berkshire group. It's such a special constellation of companies that it's better to actually keep it like that.
Yeah, no fun in keep it on Constellation software there, right?
But is there something that you don't agree with Singleton on, or think that he should have done differently?
It's hard to critique like one of your heroes, right? Like it's a tough task. I would say one of the things that surprised me about Henry Singleton, a lot of times when he would spin off these businesses, he was adamant about retaining the real estate. And that just kind of came as a surprise to me, especially considering the returns he generated on acquiring and owning businesses. It could have been just the environment and where things were, but it seems like that was a constant throughout his spinoff period. So it could just be another form of the ingenuity. He knew how to strip out the assets that were valuable and sell off the less valuable pieces. But that was somewhat surprising to me. The other thing too, it's what you admire so much about Berkshire is there was a model there that understood how to scale. And I think that Singleton's model, it was, again, you see that first constraint regarding just stitching these companies together on the technology front. And he does diversify away from that, and it becomes more profit generated. But sometimes I wonder if if there was more focus regarding, again, the qualitative components of those businesses, if that was kind of like how Buffett transitioned from a net investor to more of a qualitative type of growth at reasonable prices type of investor, I wonder how much further Teledyne could have gone. But again, that's splitting hairs. It's what he did was phenomenal, and the genius of it was he was doing a lot of maneuvers that were unique and new for that time period. Whereas now we have, case studies and textbooks that we can kind of draw from. So,
iconoclastic was the word that William Thorndike used to describe
I like that.
Him and many of the other outsiders.
Yeah,
going against the current.
Yeah, absolutely.
And we started this conversation with you buying stocks at an early age, and now you have founded and are the manager of MCJ Capital Partners. So can you tell us what happened during this period and about the firm?
Yeah, so a little bit about us. Small shop. I intend on keeping it that way. I like to find small companies, especially in the serial acquire space. I really go after these capacity constraint type of setups where bigger asset bases, they just can't pursue them yet because of size. And when we find businesses that are small and they've got a long runway and a dialed in system, especially serial acquirers of that nature, it's fun to really get in and be owners a lot earlier in the process before institutions can pile in and that sort of thing. So that's a little bit.
How many are you at?
Just me. I usually bring on analyst intern every semester that just helps with research and gathering all that. So.
And the fund is open or is it closed, or how does
that work? We operate in separately managed accounts. So a pretty nice structure. We're currently open, accepting new investors.
And maybe we can go a bit deeper into why you like the serial acquirer model so much as you seem to do. When I think about this as an investor, I've always thought that these companies can reinvest all or most of their profits into buying companies at low valuations, meaning a high rate of return. And it's this repeatability. It's not only the serial acquirer. It's also, maybe if you look at, for example, Walmart's journey, how they grew, it was kind of a blueprint for success with that you could see a long duration. So it's, when you compare this to a software company that may have great rates of return, mm-hmm. There's an issue with reinvestment. So maybe you can dig deeper into that.
Yeah, spot on. I believe, the valuation of a firm largely follows that sustainable rate of return on those reinvested earnings. So exactly what you're talking about regarding that duration piece. And when you study a company that's solely dependent on organic growth, I find those circumstances almost less comfortable than, say, a firm that is competent and really dialed in on how they reallocate capital specifically towards acquisitions. To me, it's a lot more intuitive. It makes more sense. It's strange. At a very young age, I fell in love with this model of a conglomerate. I remember coming across it, and the concept was hypnotic. It was this idea that you could have a business that performs well across all different economic cycles and be diversified and actually expand into other businesses. Obviously, if you study history, you realize the 60s took that way too far. But it's a phenomenal model, and a natural extension of that is stumbling into the world of serial acquirers and the different types of serial acquirers. And to me, those models just make a lot more intuitive sense than other types of businesses that I look at.
And regarding the climate for these type of businesses, we saw the last year, 2021, it was a boom year for serial acquirers, and really aggressive acquirers got premiums for being that aggressive, but mm-hmm. that's completely switched in 2022.
Yeah.
Maybe if you can tell us about a serial acquirer that you like and why, and what do you think about the current climate and how that is for this type of business?
Yeah, absolutely. Well, it's hard not to mention Constellation Software, but I feel like there's so much about that. I don't know how much value I can add to that conversation. And full disclosure, we own Constellation. Another serial acquirer, though, a smaller one that I think maybe your listeners are less familiar with, is Redishred Capital Corp. I don't know if you've done any work on them or if you're familiar. And again, full disclosure, we own those in the accounts we manage. But Redishred Capital Corp, it's a roll-up strategy for on-site document destruction. It's a sleepy industry, highly fragmented, low growth. It's not going to generate exciting headlines by any means. But what makes Redishred particularly interesting, I think, they're out there, they're acquiring independent operators, but they're also acquiring franchisees. And this is a model that I've studied and I'm trying to do more research on, and maybe I'll put out a paper on it. But this dynamic of being able to have a franchise platform and then layer it with a serial acquire component where you're reacquiring those franchises, it's very interesting if you think about those dynamics there, because essentially a franchisee is going out, they're fronting the capital. Not only are they fronting the capital, they're paying the franchisor to actually operate and develop a territory. And once that is mature, the franchisor, so like Redishred Capital Corp, they go in and they acquire these territories from retiring owners, these franchisees. And when they step to the table, they're the most sophisticated buyer in that relationship, because they know what this business is doing base rates compared to its other territories. They've got, an audited track record and flow of the business operation. They've seen how it's performed in different climates. They've got an inside look at this thing. And they know that the territory is proven. So it's a fascinating model. There's a few other companies out there that are doing something similar. But yeah, Redishred, I really like it. It's small in size. There's some economies of scale kicking in. They've got product lines outside of shredding. I think, where you get to the kind of hair of the investment is there is commodity exposure, because they generate nice income from selling that recycled paper. Right now, recycled paper prices are through the roof, so they're benefiting. But it's a company I really admire, and it's small in size, and maybe it's less known to your listeners.
And how do you think in terms of valuation?
In terms of valuation of Redishred?
Yep.
Exact. Well, I don't like to give my exact price point, because we could be buying if it's below that. But
okay, in general then.
Yeah. In general, I think it's very well priced where it is right now. It's at I think a significant discount, even if you strip out kind of this boom in paper prices. You can do some searching. There's some good. There were some acquisitions regarding other document destruction companies out there, and what those buyouts for the total company was for and stuff. So yeah.
And we may have confused some of our listeners. I mean, we have been talking about serial acquirers, conglomerates, roll-ups. How do you classify, what we call serial acquirers? Can you describe how you classify them?
There's a great write-up out there. I'm sure you guys have come across it. Scott Management, he put out a paper regarding his categorization. I thought it was superb, and very similar to how I think about serial acquirers, in terms of you have like a roll-up, a platform, accumulator, and then a holding company. I would say how I think of things a little bit differently is a fifth category regarding conglomerates. And for me, a true conglomerate is an entity that, it's diversified in its operations across different verticals, but it also has some sort of financial arm attached to it. So like a Teledyne, like a Berkshire, something of that nature. But yeah, usually when I'm looking at serial acquirers, I'm using those 5 buckets and putting companies in them. So like Redishred is more of a roll up. It's very much isolated to document destruction. So that's how I think through those.
And the last section we typically want to discuss in the podcast is books, of course. And we know that you like to read, and we want to know, I mean, how do you allocate your time between reading and maybe researching investing cases and so on?
Yeah, for me, a lot of it, it's kind of intermixed. It's I'll be doing work on a company, and it makes me pull a book off my shelf and look at something that I've read before, or revisit notes, or I'll do some work on a company, and I'll go out and I'll any resource I can get, I'll purchase those books or get a hold of them and just go to town using that as part of the research process. So I almost don't even separate the two, to be honest. But really with reading, I find myself more and more gravitating towards the historical accounts of these companies that are developed, and the autobiographies and industry historical write-ups and things of that nature. I find that really fascinating in a way to look at industry dynamics and how they unfold, and those competitive positions within the industry and how those have changed over the decades.
I think I was really happy, reading this book, Distant Force, that we have discussed today. And we have had a few of these titles discussed which is a bit unknown for other investors. We had an interview with Avner Mandelmann on the Sleuth Investor, and I think that's another one that's, it's not really known in this community, but it brings huge value for us as investors. Can you mention maybe one or two titles that you think are other titles that you think are underrated among investors?
Yeah. So Sleuth Investor, that's a great, how to, it's an enjoyable read too. Two that come to mind. One of my all-time favorites is Robert Gordon's The Rise and Fall of American Growth. I think it is a phenomenal 30,000 foot view account of how microeconomics and industry dynamics developed in the United States. And it's just so well quantified of, hey, this happened, and then this produced, X, Y, and Z. It's such a good book. Put it this way, I'll take that on like a vacation and read if, I'm just looking for something that I love that stuff. Another book I find really underrated is Junk to Gold. So it's the story of Copart, and written by Willis Johnson. And again, full disclosure, we own Copart and the accounts we manage. But it's similar. It has a similar feel, I think, to Robert's book on Teledyne, in the sense that it's more of a gritty account. And it really talks about those details of those early days and what they were thinking, what they were doing. And with that book, what I love about it is you can really see the full strategy, but you can also get a feel for how the culture of Copart evolved. And I think that's it's fascinating when you get those front row seats and those firsthand accounts of how a business comes to be. And I really enjoyed that book. So those would be my two recommendations.
Would be fun to discuss those another time.
Yeah, would love it. Would love it.
Well, thank you so much, Carter, for coming on Investing by the Books podcast and sharing your thoughts on Distant Force, and also talking a bit about your investment style. Is there something else you want to add before we finish up here?
I don't believe so. It was a great time. So thanks so much for having me.
And lastly, where can our audience follow you and your work?
Yeah, they can go to our website, mcjcapitalpartners.com, or I'm on Twitter, Carter Johnson 23. So yeah, that's where you can find me.
Perfect. We'll put that in the show notes and look forward to seeing you in Omaha 2023.
That sounds great, guys. I can't wait.
Thank you, Carter.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at @IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.